Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So where would we have a situation where we could get into a little bit of an advanced situation? Well, it's possible to buy calls at the bottom of our trading range, and to help finance the purchase, we could also sell puts. Now again, depending on your broker and your margins and his policies for this might be a strategy that you can do or you can't do. Now what we're looking at is the Canadian dollar. And we can see that our Canadian dollar, our dollar versus the Canadian dollar after that big sell-off down to 90, has been trading in a range here again for extended period of time between approximately 103.5 and 96.5 or 97, pretty close to there. Okay, so there are a couple of little things that we could do there. Again, come to the top of the range. We could sell the calls above the top of the range, and we could buy the puts. And again, to help finance the purchase of the puts, we could sell some calls. Okay, let's look at another possibility here. If your broker wants to make sure that you're protected for a strategy like this, you can buy 51.50 puts on the British pound here at the top of the range, sell 52.50 calls, but then you could buy yourself some protection so that the broker knows how much risk he's going to take on this strategy. Okay. So that way you would limit your risk of how much you could be wrong. Okay. And again, down here at the bottom too, you see where you've got buying 49.50 calls at the bottom of the range, selling 49.50 puts, and of course buying some protective puts just in case this position moves too far against you. Not a bad strategy in the stock market. I'm sure as time goes on this will be adapted into the currency markets. I'm pretty sure somewhere down the road, Steve's probably already got plans for maybe barrier options, which would be another advanced strategy, which we could think about too for these indexes. Okay, but I want you to notice, guys, on every chart I've showed you practically so far, all you've seen is range, 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 range. Okay, so collecting premium is where you want to be in these kind of trading ranges. Okay, all right. Markets do, though, happen to go into a trend mode every once in a while, and currency markets especially. So markets do move up, down, and sideways. And I mentioned the last time I was here, and I always mention it, I just try to define it simply as putting it into the 4 stages from Stan Weinstein. He came up with this. I see a lot of people using it. And the more people that use it, the more people realize that there are trading ranges which are defined as stage 1, accumulation after a sell-off, or stage 3, distribution after a big move up in price. Stage 2 would be an uptrend after a stage 1 accumulation, and stage 4 would be your downtrend after a stage 3 top. Okay, so you usually have a period where prices sell off followed by an accumulation. Once the price breaks out of that range and goes into an uptrend, you've got a lot of people jumping on and making money. Eventually, though, you get to the top like you just did recently in a lot of markets like oil and all that, and all you hear is oil's going to 200 or gold's going to 1,500. And, you know, of course, the people that are already long are talking their position so they can get somebody to buy from them. And what happens most of the time, it breaks out and goes down, and then people start to lick their wounds, right? Okay, here's a screenshot of the dollar versus the Swiss franc in the Forex market, the spot Forex market, and I use it just to illustrate this point. And you can see on my chart here, stage 1 accumulation. Now this is a monthly chart, so this is a long, long time frame. So you see an accumulation phase to where the prices were stable for a couple of years between 1995 and 97. And notice again the ascending triangle that started to form. I didn't draw the trend line here. I'm showing it with my pointer here at the bottom. Okay. This moving average here is a 30-period moving average. Since it's a monthly chart, it's based on the last 30 monthly closes. And this was the key to Mr. Weinstein's strategy, using this moving average to kind of keep you on a even keel as to where you were in the picture here. Okay? You see where we broke out into a big uptrend for the dollar versus the Swiss franc that lasted for many, many years until we topped out between 2000 and approximately 2004. And of course, the moving average moves along, does a pretty decent job of keeping you in here, except for a nice little dip down here. Keeps you on the right side of the trend mostly. But once you close below this trend line and this moving average, you begin something called a stage 4 decline, where this has lasted now, and actually at this point when I took this screenshot we were at 109, and I believe we bottomed at 96 cents. So markets do move once they get going. Okay. Now our euro, the dollar versus the euro, EUI, we actually did base for a period of time earlier in the year, and unfortunately the result of these braces does not always have to be a breakout to the upside, so you must be prepared for a possible breakout and a trend continuation move to the downside. Okay. I've heard this referred to, this base here, as a bearish base. Okay. At this period in time, we don't know this is going to happen. We don't know we're going to make new lows. This is one of those situations where if you were taking advantage of writing calls and such and collecting premium and writing puts and collecting premium, here's a close below this range. You must change up to a trend following strategy. You must close that position. Okay. So a new stage 4 decline happened. And we're actually showing right now what's going on at the bottom of the chart. We'll talk more about that in a couple of slides. Okay. All right. Once we get a trending market, it usually starts with a big explosive breakout. Markets that have been trading in ranges for a long time tend to wind up like a coil, like a spring, and all of a sudden we break out of a well-established trading range. Okay. Most of the time it's going to be a piece of news or economic information that will lead to a new bullish or bearish continuity of thought. I love that statement. I read that in a book one time. I've used it forever, and I say it forever. It takes a lot of firepower and a lot of traders to all of a sudden get a new bullish or bearish continuity of thought to make trend moves happen. We know about events in advance that can cause these type of moves. We've got one coming up here on Friday. We have the jobs report, which is the number one event in the currency markets. Okay. Sometimes though, you'll get one of these moves in the middle of a day or whatever, when there's a surprise interest rate cut, or there's a meeting, a Fed meeting, and a decision comes out. I mean, those you can plan for, but some of them you can't. Okay, so you have to be prepared at any time for something to change the market from trending to trading range back to trending again, and sometimes in the opposite direction, really, really fast. Okay, so unfortunately, breakouts have a tendency to fail and then retrace the entire move. Okay, so as a possible exit for this strategy, you've taken the risk on the breakout. You must at some point take some of the profits. We teach everybody tools such as the Fibonacci retracement tools. These are great tools to help you capture at least a portion of that breakout. Okay? You can also sell options, all the options that you have, if there is a greater than a 61% retracement, if you want to use a hard, fast rule. I say, for instance, if price goes up 50%, it goes up 100% and then retraces 50% of it, I must take a profit at some time, because there's a good chance that I'm pretty soon going to be looking at a 100% retracement and asking myself, why? Why didn't I take a profit?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.